Hi, I'm Roger Montgomery from Montgomery Investment Management and welcome to this week's Video Insight. Several friends have asked me to let them know when I decide to make additional investments in equities. Of course, I can't predict what will happen in markets in the short term. I guess there's security in numbers. And over the longer term, I'm acutely aware of the old investing aphorism, and that is the lower the price you pay, the higher your return. Now, have a look at this chart from Ed Yardeni Research. It reveals the PE ratio, the price earnings ratios, for both small and mid-cap companies. Now those ratios you can see are approaching the lows of the COVID 2020 correction and equal to the 2018 correction. As you look at this chart, remember one thing. The circumstances surrounding each previous PE low was different. For example, when the stock market sold off aggressively in 2018, the US Federal Reserve quickly changed tack and ceased raising interest rates before cutting them again. And of course in 2020, the COVID lockdowns prompted unprecedented fiscal and monetary stimulus. If you believe what the Fed is saying today, that's unlikely to be the case this time around. In fact, they want inflation to get back down to 2%, so their comments are becoming more hawkish. But there might be some good news. The latest US inflation data is starting to show the benefits of a higher month-to-month base effect. You might recall US inflation recently peaked at 8.5% back in March, before falling to 8.3% in April. Of course, whether the market likes this or not depends entirely on sentiment. Investors in the US may dislike the falling inflation rates today by pointing out that it was around this time last year inflation started taking off. So today's numbers are benefiting from the base effect of last year's high numbers and are therefore still too high today. You just don't know how markets are going to react. Good news one day could be bad news the next day. Importantly, however, the higher interest rates expected from the Fed are almost entirely responsible for the sell-off in the stock market so far. That's what's caused the PE compression we've seen to date. Unless the Fed surprises with even more aggressive rate hikes, the future direction of the market should now be determined by earnings growth, given the PEs have already compressed so much. Many investors, of course, are worried about a recession and the impact that will have on earnings. A recession may indeed be on its way, although current economic forecasts for the rest of 22 and 23 aren't suggesting any negative rates of growth. So, with PEs now at recent historical lows, I'd prefer to look at the earnings growth of the companies we actually own. When I first invested in the Poland Capital Global Small and Mid-Cap Fund, I didn't expect the unit price to decline by nearly 40%, but it has. The aggregate forward PE ratio of the stocks in the fund at the inception of the fund was 44 times earnings. That has now fallen to 25 times. If I break up the PE multiple compression of the portfolio into its components, we find about 70% is due to lower prices, but 30% is due to higher earnings that the companies have generated. And that's the point. Poland calculates the companies in the portfolio have grown earnings by nearly 25% per annum over the last 5 years on revenue growth of 18.5% per year over the same period of time. Annual earnings growth for the next 5 years is estimated to average between 20 and 25%. Every company in the portfolio is generating profits and has a very strong balance sheet, and no companies in the portfolio are cyclical. So with all that in mind, have a look at this chart again. It might explain why Berkshire Hathaway has spent more than $51 billion on stocks in the 3 months ending March 31. And I trust you can see why I've instructed my banker to transfer additional funds into the Poland Capital Global Small and Mid-Cap Fund. So my friends who wanted to know when I was investing more money in equities, that time is now. And if the market does continue to fall, I'll be calling my banker again to continue the process of dollar cost averaging. That's all we've got time for today. I look forward to talking to you again in a week or so. And in the meantime, keep following us on Facebook and Twitter.